The last trade on DuPont and Nemours Inc. NISE-DD was at $39.80, marking an intraday movement of plus 0.65 or a 1.66% increase for the day. Now, the common expectation right now, especially after a mixed earnings report a few days ago, is a certain degree of volatility, a kind of choppy sideways grind, as the market digests the numbers and the major portfolio restructuring. But here's the unexpected angle that matters right now. The stock's recent price action suggests that the market is already discounting a significant portion of the business cycle weakness, particularly in construction and some industrial segments. The fact that the stock is holding up with this strength, even with the noise around the latest quarterly report, which technically missed some headline analyst consensus figures but raised full-year operating EBITDA guidance for the new DuPont structure, tells you there's a forward-looking confidence at play. It's not just about the quarterly beat or miss, it's about the post-spin trajectory. The primary belief in the analyst community and among many general online investment participants is that DuPont is an old-guard chemical giant, a slow-moving cyclical stock whose success is entirely tied to the housing and construction markets, meaning a higher-for-longer interest rate environment is a death sentence. That's the narrative that keeps the stock priced in the lower end of its recent 52-week range. However, the reality is far more nuanced, and it's being reflected in the institutional moves we're seeing. This isn't the same DuPont that was part of the Dow-DuPont conglomerate years ago. It's a focused specialty products and components company. The core thesis that is starting to gain traction and is driving this underlying strength is the hidden growth engine in its electronics and industrial segments, specifically the components focused on semiconductor technologies and advanced packaging. While construction has been a drag, the parts of the business serving high-end computing, data centers, and the push for AI-driven technology are experiencing substantial demand. We're talking about high single-digit organic sales growth in interconnect solutions, largely driven by these AI and advanced technology ramps. That counter-cyclical growth is the reality that challenges the simple cyclical stock expectation. This is a transformation that warrants a reevaluation of its peer group and valuation multiples, moving it closer in spirit to specialized tech-adjacent materials plays than to traditional basic chemicals. Looking at the short-term movement, the recent earnings report was a classic case of expectations versus reality. The headline numbers, adjusted EPS of $1.09 against an analyst consensus of around $1.16, sounded like a miss, yet management came out strong, raising the full-year 2025 operating EBITDA guidance for the new streamlined DuPont structure. The negative headline was quickly overshadowed by two major strategic actions that signal confidence: a new $2 billion share repurchase authorization and the immediate launch of a $500 million accelerated share repurchase (ASR). For institutions, this action is a loud, clear signal from the board that they believe the DuPont stock is undervalued. They are putting their capital where their mouth is, and that is a major difference maker compared to a simple press release. This capital allocation decision is arguably more important for the short to medium-term stock price than a 7-cent EPS miss. The volume on the stock has picked up significantly following the news, indicating high institutional trading activity, especially with firms like Bank of Montreal Can increasing their position. This is sophisticated investment capital seeing an opportunity in the disconnect between the mixed earnings report and the strong forward-looking guidance coupled with aggressive buybacks. The structure of the stock right now is defined by its recent portfolio shuffle. The company has completed the separation of its electronics business into a standalone entity, a strategic move aimed at focusing the remaining new DuPont portfolio. What's left is primarily water and protection and a highly specialized subset of electronics and industrial materials. The water and protection business, which includes things like the widely known Kevlar and Tyvek products, plus water filtration and purification systems, is largely tied to infrastructure and healthcare, two areas with more resilient secular growth than general construction. This is a point often missed by retail investors who only see the cyclical housing connection. The high growth component is tucked away in the performance materials side, and that's where the market is now paying closer attention. The company's historic performance, which saw it emerge from the breakup of DowDuPont, has been a story of continuous simplification and shedding the low-margin, highly cyclical baggage. Past reports leading up to this latest separation consistently highlighted management's intent to create a higher margin, less volatile business, and the third quarter results, especially the organic growth in the water and medical packaging segments, confirm that narrative is playing out. The macroeconomic pressures are real, and they act as the primary headwind. The weakness in the broader construction and shelter end markets is a genuine drag on parts of the water and protection business. No matter how much Fidelity or Interactive Brokers clients want to believe in a quick recovery, the data on new home starts and commercial construction remains soft, particularly in North America and parts of Europe. This is the central tension that keeps the stock range-bound despite the internal fundamental strength. On the other hand, a potential Fed pivot or even a soft landing scenario where inflation cools without a deep recession would provide a powerful tailwind. If the cost of capital eases, the long-delayed construction projects come back online and the material demand immediately spikes. That's the classic upside scenario for a stock like this. But smart money isn't waiting for the macro environment to clear up. They are trading on the micro story, a shrinking, more profitable, and higher multiple company emerging from the restructuring. Now let's look at the future outlook. DuPont's management is targeting medium-term growth with a 3 to 4% organic growth rate and 8 to 10% EPS growth by 2028. These aren't the explosive figures you see from a Tesla stock or Nvidia stock, but for a specialized materials company, they represent a steady, predictable path to value creation, particularly when coupled with significant share buybacks, which boost EPS mechanically. The key catalysts to watch are twofold. First, the successful execution and ramp-up of their high-value material contracts tied to the semiconductor and AI build-out. Every time a company announces a new powerful chip, it likely means more specialized material demand for DuPont. Second, the performance of the newly separated entities and how the new DuPont executes on its margin expansion plans. The risk remains a deeper than expected or prolonged slump in construction, which would eat into their top-line revenue regardless of the growth in their specialized segments. A retail investor using a platform like Robinhood for self-investing might be intimidated by the complexity of the recent corporate actions and the mixed earnings. But for those who value corporate focus, balance sheet strength, and a clear path to returning capital through buybacks, the current price is a compelling entry point into the new entity. The valuation appears attractive relative to its new peer group, particularly as it sheds the cyclical label. The analyst consensus rating is generally a buy, with a wide range of price targets reflecting the uncertainty around the timing of the construction recovery, but also the upside of the specialty materials business. It is a classic stock that benefits from a thorough look beyond the headlines. You can't simply lump it into a basic materials ETF and call it a day. This demands an individual brokerage account perspective and detailed analysis. The underlying reality is a company transitioning to a secular growth profile while the market's expectation remains anchored to its cyclical past. This is the disconnect where the profit potential lies. To better understand the sentiment and position sizing on the street right now, comment below how many shares of DuPont de Nemours Inc. NISEDD stock you currently hold, and what you think the biggest catalyst for the stock will be in the next 12 months. Is it the AI semi-material demand, or is it a surprise housing market recovery? Your input gives us a real-time read on how investors, whether through platforms like SoFi Invest or larger institutions utilizing Fidelity investments, are positioning themselves. In summary, the DD stock price is showing unexpected strength post-earnings, driven by the forward-looking guidance, the significant share repurchase program, and the growing high-margin exposure to specialized markets like water filtration and semiconductor materials. The tension between the market's expectation of a slow-moving cyclical industrial name and the reality of a nimbler, more focused specialty products company is creating a genuine opportunity for value appreciation that goes beyond a simple one-time earnings beat. Keep your eye on those high-growth segments because they are the foundation for the stock's next sustained move higher. The management is using financial engineering, the buyback, to compress the valuation multiple while the fundamental business transformation does the heavier lifting of organic growth. This is a powerful combination that shouldn't be overlooked.